So we've all been there, right? You're at work and your coworker just can't stop showing everyone pictures of their brand new kitchen. They're throwing around words like equity and investment, and you feel this little pit in your stomach. You smile, you say congratulations, but that little voice in your head is asking, am I falling behind? Well, today we're going to explain why the answer is no. You're not the problem. The story you've been sold is. Ah, yes, this old chestnut. You've heard it a million times, I'm sure. From your parents, your friends, probably even from some guy at the gym who really has no business giving out financial advice. It seems to make so much sense on the surface, doesn't it? But what if it's not just a little off? What if it's one of the most expensive lies you've ever been told? And that's really the core question we're going to tackle. We are going to unpack the actual math behind this statement. Because I think once you see the cold, hard numbers, you're going to start to wonder if that American dream of owning a home is really a dream at all, or if it's more of a trap. Okay, so let's get right into it. The real cost of owning. You see, when people say renting is throwing money away, they conveniently forget about all the money homeowners are also throwing away. The difference is, for a homeowner, the money is going out in so many different directions that it's harder to track. So let's make it visible.
Let's start with the mortgage payment itself. This part is so important, especially in the early years. Let's say you get a loan for $350,000. Your monthly payment is, around $2,300. But here's the crazy part. In that first year, a massive $2,000 of that goes straight to the bank as interest. Only about $330 is actually paying down what you owe. That's all you're building in equity.
And oh, we're just getting started. On top of that interest, you've got property taxes every month, poof, gone forever. You've got homeowner's insurance, another few $100s, also gone. Then there's maintenance. The rule of thumb is the 1% rule, which means you should expect to spend about 1% of the home's value on repairs each year. That's another $300 a month. Vanished. And if you didn't put 20% down, you get hit with PMI on top of all that. None of this is an investment. It's just cost. So here's what that looks like in reality, month to month. You are gaining about $330 in equity. That's your investment. But you are throwing away nearly $3,000 when you add up all those other costs. That is staggeringly inefficient. I mean, think about it. If you put 10 gallons of gas in your car and 9 of them just leaked out onto the pavement, you'd say the car is broken. But when a house does that with your money, we're told it's the American dream. Okay, so that's the monthly view. But what happens when you zoom out? What does this look like over the long haul, say 30 years? Well, this is where the math gets truly mind-blowing. We're going to set up a little financial race here, the savvy renter versus the successful homeowner. All right, let's meet our competitors. First up, we have our renter, paying a simple, predictable $2,000 a month. And in the other corner, we have our homeowner, whose total all-in cost, mortgage, taxes, maintenance, the whole shebang, is $4,000 a month. Now, here is the absolute key to this whole thing. The renter takes that $2,000 difference and invests it every single month. So, fast forward 30 years. What happens to that $2,000 a month that our renter was consistently investing? Well, assuming a pretty standard, even conservative, 7% annual return from the market, that little pile of money grows into $2.4 million. And we're not talking about equity you can't touch. We're talking about liquid, accessible, actual money. So let's look at the final scoreboard here. Now, don't get me wrong, the homeowner did okay by traditional standards. Their house appreciated. It's worth almost $1 million, but they also paid nearly $500,000 in just interest, not to mention hundreds of thousands more in taxes, maintenance, and insurance. After you subtract all those costs, their net wealth from the house is about $340,000. The savvy renter, $2.4 million. It's not even a fair fight. Now, let's be really clear about something. There is one massive caveat here. This only works if our renter is disciplined enough to actually invest that difference. For a lot of people, if that money is just sitting there, it's gonna get spent. And for those people, a mortgage payment can be a good thing. It's a forced savings plan. You have to pay it. And that is, without a doubt, the single most valid argument for buying a home. So if the math is this clear, then why is everyone still so obsessed with buying a house? Why does this myth have such a powerful grip on us? To understand that, we have to look beyond the numbers and into the psychology of it all. A huge part of the answer is pretty simple. Just follow the money. I mean, who gets rich when you buy a house? The real estate agents get their commission, The mortgage brokers get their fees. The banks get to collect interest from you for 30 years. The home improvement stores love you. There is an entire industrial complex that makes a fortune only when you buy. So of course that's the advice you're going to hear over and over again.
I absolutely love this quote because it hits the nail on the head. People love to talk about their equity, but you have to ask yourself, is it real? You can't use it to buy groceries. You can't pay for your kids' college with it. It's theoretical money. It's just a number on a statement that only becomes real if you sell the roof over your head. And, well, then you got to find a new roof.
This whole thing really boils down to a fundamental trade-off: freedom versus an anchor. As a renter, you have flexibility. A dream job opens up on the other side of the country, you can go. You hit a rough patch financially, you can move to a cheaper place when the lease is up. You have liquidity. But a homeowner is anchored. They are tied to one specific location and a massive, relentless monthly payment. That so-called asset can feel more like a prison with really good marketing. All right, so we've poked a lot of holes in the old way of thinking. What's the alternative? How do you actually win at this game? Well, the very first step is to stop playing by their rules. You have to redefine what winning even looks like. Let's do that right now. Winning isn't about having $500,000 in debt to a bank. Winning is having liquid investments that are actually working for you. Winning is the freedom to make choices about your life and career. It's sleeping soundly because you know that if the water heater explodes, it's not your problem or your $10,000 bill. That's real wealth. So here it is, your 4-step path to actually winning. 1. Calculate. Do the real math on what owning that house you've been eyeing would actually cost every month. 2. Compare. Put that number side by side with your rent. 3. Invest. This is the non-negotiable part. You have to commit to investing that difference. And number 4, which might be the hardest part, ignore. Tune out the social pressure. You're not playing their game anymore. You're playing to win. Because ultimately, that's what this is all about. This isn't about just owning stuff. It's about having control. Control over your finances, control over your time, and control over your future. True wealth is having your money work for you, not the other way around. So I'll just leave you with this one question to really think about. That dream home, the one you've been conditioned to want your entire life, after seeing the real numbers, is it truly a financial asset that's going to lift you up, or is it a financial anchor that's going to hold you down? The math, my friends, does not lie.